Welcome to Handout 4. I'm Anthony. I'll be educating y'all today. Alrighty, okay. So bear with me. It's kind of late, kind of tired. Alright. Question 1. Oh yeah, so if you haven't seen the epic video I made about this, please go watch it. You'll be able to understand and make your life 10 times easier. Alright. Purchased equipment for cash is recorded as a debit to equipment. Correct. They did that correctly at least. And a credit to accounts payable. Wrong. They did that wrong. I'll tell you right now. Wrong. Alright. So, the purchased equipment. So we're going to put $100 here. And credit to accounts payable. So this is what they did, right? Nice T accounts, everything super fantastic. So next is what they should have done. So they purchased it with cash. So equipment, 100, and cash should have been reduced by 100. So what they recorded says that they just got equipment and they bought it off on a credit card, for example. So their assets increased. But it should have been assets increased and assets decreased, evening each other out. So that causes assets to be overstated, liability overstated because there should not be an accounts payable, and net income, nothing is touched there. Bam. Question 1 done. OON. Alright, next question. Question 2. Failed to record the purchase of merchandise inventory on account. So they failed to record. Being inadequate, they didn't record it. So no journal entry. However, this is what they should have done. Accounts payable and accounts and an inventory account. Well, I mean purchase account, sorry. Because you got to read the instructions up top. It says Alpha uses a periodic inventory system. Those of you who don't know this yet, listen up. This is very important right now. Purchase account is like an expense account. Bear with me right now. It's mind blowing right now, but purchase account is like an expense account. There is no inventory account in perpetual and periodic inventory system until the end of the year when the purchase account closes and moves over here to assets. So what happens here? Assets, no effect because we're not at the end of the year yet, so nothing would be coming over here regardless. They failed to record an accounts payable. I'll follow my own rules. Put some numbers here. So 100. Now debits must equal your credit, so 100 here. Right? So failed to record an accounts payable, so understating liability. And with this fantastic outline, we understated our expense, which is a purchase account. So we go, don't go to this one, we don't go to this one, go to the two expenses. Under expensing, so we go with 100 minus 40 equals 60, overstated. And you owe. Bam. Question 2 done. Cash received from a customer in payment of its existing account is recorded as if the receipt were from a current period sale. Alright, many issues here. Alright, so cash received from customer is recorded. Oh, payment for an existing account receivable was received, but it was recorded as a sale, a new sale. So this is what they did. Said cash. Let's make this a little big for you guys. $100 and sales. Right? But they messed up. They should not record it as sale. So what they should have done is just receive cash, reduce accounts receivable. Alright, so let's go up. So liability. Nothing was touched in liability, so no effect. Assets. Shows that we're just receiving cash, not reducing accounts receivable. Overstated. Sales. Come back here to this diagram. Overstating revenue. Bam. Overstated. It's getting really easy. O and O. Question number 4. Recorded a credit sale as a debit to cash and a credit to sales. You recorded a credit sale as a debit to cash and a credit to sales. So we go. Cash of 100. Sales 100. Which is incorrect. So instead, they should have recorded this as accounts receivable. So this is what they should have done. And then once they receive the cash, scenarios like this, once they receive the cash, then they recognize, then they reduce the accounts receivable. So when they receive it, accounts to 100, and then cash 100. So this is one part, and this is the second part. All right. Alright, but since we just the asset which correct account it was supposed to be in, it was just in the wrong account, but it's still on the asset side. So no effect, because nothing was done. Everything was recorded in the same balance remained. So the balance issue didn't make it offset. So no effect, liability. No effect, no effect, because the sale recording was still correct. Number 5. A receipt of money from a bank loan is recorded as a debit to cash and a credit to sales. Receipt of money from a bank loan is recorded as a debit to cash and credit to sales. Alright. We can still use some of this old question. So this is what they did. Received cash and recorded it as sale. But this is what they should have done. Cash 100, no payable of 100. So the assets, no effect. Liability understated. We recorded a sale, which we shouldn't have recorded a sale, overstating revenue, thus overstating net income. NUO. Question number 6. Failed to record depreciation at the end of the current period. Alright. So, failing to record depreciation, right off the bat we know that it's going to be an expense. So we're either going to be dealing with this one or this one. So, okay, so they failed to do it. So no AJE. No AJE. But accumulated depreciation, accumulated dip. Accumulated dip is a contra asset account, so it's located here. Oh, let's get 100. And depreciation expense. So, no effect on liability. Assets, you forgot to depreciate it, so you're making your equipment look like it's more valuable than it actually is. So, you overstated your assets. You forgot to expense, so you're under expensing your expenses, which will overstate your net income. Now, okay, that was correct as well. Seven, failed to record adjusting journal entry. So right off the bat, we know they failed to record, so no AJE. Right? No AJE. Salaries are paid every Friday for a 5-day work week. The normal weekly payroll is $40,000. The year end falls on a Tuesday this year. So, at the year end falls on a Tuesday, so you still have two more days to add into your year's expense. So, they forgot to do sal payable. What is the number? 100. And then salaries expense. So, assets, no effect. Liabilities, you forgot You're supposed to have $100 of liability, but you don't have, you're not showing it. So understated, you have $100 of expense, you're not showing your expense. So we come back over here, you're understating your expense, overstating your net income. O. And you owe. Almost done. Eight. Fail to record adjusting journal entry, examining the rent expense account. The controller finds that it included a $400 advance payment for 3 months of rent. The payment was made on November 1st. So this means that they have 1 more month of rent. So this is an unusual adjusting journal entry because they expensed it all up front. And is this a no adjusting journal entry? Yes. No AJE. So that means that they have $16,000 of rent left. So I'll go pre-rent, 16K, and rent expense is being reduced by 16K. Okay, let me do a backtrack on this. So this is what they should have done. But up front, when they originally did it, the 45, is it a 45? Oh, 1600. Okay. So 1600. Pause this real quick. So this is what they did up front originally. So they did cash of the 4,800 and they just expensed all of it, rent expense of 4,800. On November 1st, they just expensed all of it. At the end of the year, they say, oh, we still have 1 more month of rent, so let's reduce the expense. We're expensing way too much. So that's when they reduce the rent expense by 1,600 and they bring it back to prepaid rent, increasing the assets, decreasing the expense. Alright, so no adjusting journal entry, prepaid rent. They forgot to do this, so assets understated. Liability, we didn't do anything with liability, so no effect. Rent expense, we're over expensing because we didn't reduce expense. So we go over here, over expense, so 60, understated. And U and U. 9. Fail to record adjusting journal entry. There is 500 of office supplies left in the storeroom. At the beginning of the year, there was no supplies. No office supplies. During the year, 3,500 office supplies was purchased. Alright, again, no adjusting journal entry. So, of 3,000. An expense of 3,000. See, because they had 500 left on hand, but they expensed 3,000. They purchased 3,500. So they didn't. Now this is them recognizing the usage of the supplies, reducing supplies by 3,000 and expensing of 3,000. So again, so we come over here. Liabilities, nothing was touched. So N. assets, we're showing that we still have 3,500 of supplies, but they don't. They're inadequate. They forgot to do adjusting journal entry. So they're overstating their assets, and they under expensed their expenses, basically under expensed it. So 40. So overstating net income. 10. Failed to record adjusting journal entry. The company received an order in May with a $13,000 of advance payment, which was credited to unearned revenue. In November, the last of the orders was shipped to customer. Alright. So the number is 13,000. So failed to record adjusting journal. The company received an order of 13,000 advance payment, which was recorded. Alright, so we'll go a little backtrack on this one. So once you unearn service revenue is a liability. So when you get your cash, so you go cash, what's number 13K? And liability of unearned rev of 13. Because you still have an obligation to fulfill to recognize this revenue. So they're saying by November they fulfilled all their obligation. So they forgot to do this part. They forgot to reduce unearned service revenue by 13K and recognize sales revenue by 13K. So they forgot to do this. So assets, no effect. They overstated their liabilities, so over. Revenue was understated because they forgot to recognize the revenue because they fulfilled the obligation. So we go revenue under, 90, under. NOU. 11. Failed to record adjusting journal entry. The company has 20K 9-month note payable outstanding at the end of the year. The note was issued October 1st. The interest is to be paid on a note when the note is paid. Alright, so they did everything correctly here except they're forgetting to recognize interest expense. So this is what they did. So again, no adjusting journal entry, and for the month of for the rest of the year, they basically got charged interest. The way you find out the interest is you go 20,000 times 12%, and then times 3 divided by 12. So 3 months of the year. So you go like that equals 600. So they forgot to expense $600 worth of interest. So this is what they did. So interest payable of 600, interest expense of 600. They forgot to do that. So assets, no effect. Liability, they have 600 of liability, but they didn't record it. So under, they're showing less expense. They should be showing $600 of expense, but they're showing 0. So they're understating their expense. So over. NUO. Alright, this was super fun. So this is helpful. Please like the video. If you didn't find it helpful, well, I don't know what to say. So good luck and see you in the next handout video. You guys are very lucky.